Hi everyone! Last week was rather tense as traders anticipated the Fed's rate decision. Stocks ended the week without losses despite a rate hike, expectations of further monetary tightening, and the ongoing banking crisis. All three benchmark stock indices managed to climb. Nevertheless, the cautious sentiment still prevails. Investors prefer safe haven assets as they are skeptical that the banking crisis is over. This is why an upward movement on Wall Street is rather weak. A reversal could occur at any moment. Minneapolis Fed President Neil Kashkari warned that the stress in the banking sector and the likelihood of a credit crunch brings the US closer to recession. This week, several Fed policymakers will give their speeches. The US will unveil the core CPI and revise GDP figures for the fourth quarter. Watch our video till the end and leave your comments down below. Let's start. On Wednesday, the main stock indices slid down as sentiment turned sour following Jerome Powell's testimony. He said about another 25 basis point rate hike at the next meeting. However, the Fed chair made it clear that the regulator was not going to ease monetary policy. On the contrary, the central bank could undertake new aggressive rate hikes if needed. Inflation remains at unacceptably high levels, so the Fed's priority to push it to the 2% target remains intact. The initial market reaction was rather negative. However, after carefully analyzing Powell's comments, investors were not so pessimistic. They even saw dovish hints in Powell's speech. For instance, the policymaker mentioned only one rate increase. Some investors are confident that the central bank may soon end their tightening cycle to mitigate risks to financial stability. At the end of the week, stock indices recouped some of their early losses and entered positive territory. The Dow Jones gained more than 130 points on Friday, while the S&P and NASDAQ grew by almost 0.6 and 0.3% respectively. The upward movement occurred at a time when concerns about financial stability persisted. Deutsche Bank shares fell by 3.1%, recovering from a 14% decline earlier in the session. Stock indices also kicked off their new week with growth. The sentiment was moderately positive. Trading on Monday was quiet, like a lackadaisical, so there is no need to focus on the results of that session. Overall, investors continue to assess the risks of the banking crisis and the prospects for the Fed's monetary policy. The US government is trying really hard to boost confidence in the banking system. It is considering the expansion of an emergency lending facility that would offer banks more support. Lawmakers also noted that the financial system remains sound and resilient. However, investors are still wary. The Dow Jones was almost unchanged last week, adding only 0.1%. Curiously enough, there are no drivers for its further rise. The economic calendar is relatively empty this week. Only consumer confidence data may trigger volatility. The index may drop after the release of revised GDP figures. If the reading is strong, it will signal further tightening. If the indicator is revised downwards, it will point to economic problems. Janet Yellen's speech may also affect equities. She may announce changes in economic policy. Investors continue to digest Powell's speech at the press conference. Thus, there might be a change in sentiment. Although the US government has done everything possible to abate market fears, it somewhat failed. Inflation is dropping, albeit at a slower pace. It means that the Fed will hardly soften its stance. In addition, Powell's speech was a little bit different at the last press conference. He usually speaks coherently without making any pauses. Last time he made them many times. He also asked to repeat questions that were a bit tricky. The Fed chair did not say anything new. The central bank is strongly committed to a hawkish stance despite the banking crisis. However, it will provide support to struggling banks. Speculators will carefully monitor the situation in the banking system. Despite the reassurance of the authorities and the lending program, the risks of new bank runs are still high. For some reason, market participants assume that the restrictive level for rates is located at 5%. They are again making predictions solely on their expectations, not facts. It seems they did not learn the lesson. As a result, they could again face losses due to their groundless optimism. In any case, the stock market is now at a crossroads. It may resume a downward movement amid worries about the state of the economy and the lack of strong drivers. As for the S&P 500, there were also no important weekly changes, yet the index gained 1%. It is still unable to reach 4,000. Buyers need to push it above this level to cement a steady rise. If they succeed, the S&P may move to the range of 4,150–4,200. Yesterday it broke through 4,195. However, the bulls encourage a strong resistance level. The support level is seen at the level 3,800. If the index drops below this level, settling at 3,800, a deeper downward movement may take place. The key targets for the bears may be the levels of 3,630 and 3,490, the low of October 2022. The prospects of the stock market are quite ambiguous. If the Fed keeps the key rate at a high level throughout 2023 and reduces its balance sheet, a recovery looks rather unlikely. Market reaction to the comments of Fed officials is now muted. Perhaps the effect of the rate increase has not fully been seen yet, so it may impact the equity market a bit later. Traders are clinging to false hopes. Since early March, the yield of 10-year treasuries has decreased to 3.4 from 4%, which indicates confidence in a policy reversal. Yet nobody knows whether there will be a change in stance. Perhaps the banking crisis is more perilous and policymakers are just trying to ease concerns. In case of another collapse, the Fed will have to expand the lending program, injecting money into the banking system. It doesn't matter what it's called, quantitative easing or the lending program, the effect is the same. In the meantime, the Fed assures traders that it is able to keep inflation and the banking crisis under control. Investors believe that inflation will soon stop being a priority. This is why the central bank could abandon aggressive tightening. The heavy tech NASDAQ 100 was the biggest gainer. It advanced by more than 2%. Currently, it is rather alarming that the Dow Jones and NASDAQ indices are giving mixed technical signals. However, they are unlikely to go in different directions for a long time. They have to choose one trajectory. Last week, the NASDAQ touched the highs of August 2022, while the Dow Jones recovered to the March opening levels. For the NASDAQ, the banking crisis is a positive event, especially amid expectations of a policy reversal. The Dow includes the shares of companies that are less sensitive to the cyclical downturn in the economy. The risk of the banking crisis adversely affected the Dow. Buyers failed to retain momentum following Powell's comments. A strong sell-off followed. If fears over financial stability intensify, the index may decline lower. It may even tumble below the last year's lows of 30,000. The NASDAQ has been rising for the most part of March. However, last week there were many dips and short-term increases. It appears it is losing momentum. At the same time, the bullish outlook is still relevant. However, analysts doubt that it could last long. The European Central Bank, the Fed, the Bank of England, and the Swiss National Bank unanimously raised rates last week, increasing pressure on the financial system. Thus, central banks are not ready to abandon monetary tightening. They are sure that the banking crisis will end soon. If so, stock markets are sure to climb higher. The Dow may not notch better results than the NASDAQ. Markets breathed a sigh of relief as the first weekend in 3 weeks passed without new woes in the global banking sector. They also welcomed the news about additional support from the US authorities. Shares of First Republic Bank jumped by almost 15%. The US is considering expanding an emergency lending program for financial institutions. It will give the lender more time to strengthen its balance sheet. First Citizens Bank Shares Incorporated agreed to buy Silicon Valley Bank. This news also helped ease concerns about stability in the sector. Besides, German Deutsche Bank shares, which were in the spotlight and caused Friday's volatility, also recovered. Investors are now rather cautious. They are not sure what to expect next. For example, Morgan Stanley believes that, given the turmoil in the banking sector, profit forecasts of US companies look too positive. After the publication of earnings reports for the first quarter, stocks may decrease markedly. The earnings season will start in mid-April. In the first half of the year, the US stock market is likely to face a sell-off. The S&P index may return to the lows of mid-October last year. It could even drop to 3,000. A trend reversal is expected in the second half of the year. However, stocks will hardly be able to win back their losses till the end of the year. Analysts at Morgan Stanley assume that the S&P index could remain 2% below Friday's closing level by the end of the year. That is all for now. Subscribe to our channel and keep close tabs on market developments. See you!